Hello, folks. Brandon Chapman with you today. It's another edition of the Theo video for, what is it, December 12th, 2022. We're now nearly about 2 weeks away from Christmas and other holidays that people celebrate. But boy, of course, everyone's waiting for the Santa Claus rally that occurs between Christmas and New Year's. Certainly, people are hoping this week that Powell will set the tone, that he's going to be dressed in red fur and help generate the upward movement leading into the end of the year. We'll see whether he's Santa or Grinch, but this is a big week. And boy, today, as the market was nearly 1.5% higher, volatility expectations soared into the close today, expecting more movement throughout the week than they'd expected on Friday's close of last week. Anyway, let's get rolling. So the S&P, the SPX, up 1.4% today, closing near the high of the session. Such, bullish anticipation. We end up holding this support about 39.20. Looks like we might be poised to roll higher to 40.34. Now, that would assume that nothing eventful was going to go on the rest of the week. But this week is full of very significant events that are about to take place. First and foremost, tomorrow. Tomorrow. FOMC meeting begins, but more importantly, you'll notice that CPI is coming out tomorrow morning about an hour before the market opens. This has created significant volatility in the past because why? Well, a hot number means that the Fed may raise rates more than expected or stay on their current path. That's not what the market wants. Higher interest rates in this kind of environment hurts multiples, earnings multiples that you're willing to pay stocks. It increases borrowing costs. It diminishes consumer spending, future spending, buying fewer widgets because each widget costs a lot more. So the bottom line is CPI is going to be very influential on the movement this week. The FOMC statement and the press conference. And this is the ultimate right here. Once we digest the CPI data, again, how is Powell dressed? We already know his heart is 3 sizes too small, okay? The question is he going to try to ride it off with the Santa Claus outfit, or is he coming as the Grinch? We'll have to see and wait till then. What they say in the announcement, right? So the announcement comes out about a half hour before. What are they articulating? What's the terminal rate going to be? That basically means how high are they going to go in the coming months before they stall or potentially start to reverse policy? When does it look like they're going to reverse? What's their statement of the overall strength of the economy? That may lead to how high they may want to go. Are they seeing material weakness in earnings, of jobs and ultimate like orders and inventories? Again, a lot of that stuff may not be fully addressed there, but there's going to be questions on that during the conference. And we'll see what Jerome Powell produces and whether he decides to be more bullish or more hawkish or more dovish. Dovish is more hawkish, meaning less likely to raise rates, or indicating that, or the opposite. Is he going to be the Grinch? Is he going to be the hawk? Is he going to talk about higher rates for longer, et cetera? A lot kind of keys off of tomorrow's data point with the CPI leading into the press conference and the statement on Wednesday. So bottom line is expect to see more volatility. And you see that by looking at the VIX today. So the SPX 1.5% higher, the VIX up 2 points, trading at 25. Very surprising. Normally you'd expect to see the VIX decline on a rally like we're seeing today. Instead, we're seeing increased hedging, buying puts today in lieu of a major surprise coming up this week. One of the ways you can more cheaply kind of hedge downside is buying an out of the money vertical spread for this week, or buying in the money puts. The cheapest way, and unfortunately we're at the close, we're going to get the CPI data tomorrow, is just closing some stuff out, reducing your exposure. If you don't have much invested, this week may help provide some clarity, but really the big trade is going to occur next year as the recession indications are probably going to pick up, unemployment, et cetera. So this isn't a terrible time to kind of sit back, watch the show, reduce your exposure, et cetera. And that's what they did today, right? Buying more put protection into the higher market today, and which again, very, very unusual to see. Normally see the VIX go down as the market goes up. in particular when you see the market up 1.5%. So it just shows that the market itself is a little concerned about what this week may hold. This isn't accurate as of today, but even Friday, you saw an uptick in the skew level to about almost 119, 120. Do we see an increase in skew today? We're not going to get the data point for maybe another half hour, but soon we're going to see. Did we see a rising VIX and rising skew? Again, is this reflective of increased hedging going into this week? Certainly we're seeing that in terms of buying put options. Are we also seeing it in implied volatility skew more for the SPX options as well? Anyway, so a lot of stuff coming up this week that could really move the market. Now, again, this isn't a time where you load up the boat on potential plays. Sometimes it's about reducing your exposure. As many of you probably know, I've been pretty bullish on China's reopening. That's a very loose term, right? Did they loosen restrictions? Yes. Was there the optimism, the trade coming off the lows? One of the stocks I've kind of avoided because it's gone up so fast is Melco Resorts. They got representation in Macau. And again, they benefited a lot just by the news. And what you saw today, again, if the Fed comes out more hawkish, CPI data is hot, there is the chance that the dollar strengthens. And in that, that may reduce, emerging market prices of stocks and other stuff. And so as we look at MLCO today, what you're seeing, and this is something you want to typically try to do, you look at this right here, 22,000 contracts. This is less than the open interest, right? This is greater than the open interest. What you're seeing is a roll from the 10 strike to the 12 strike. So yes, it's bullish, meaning they're keeping interest on at 12, but it's also a matter of taking a certain amount of profits off of the table in this trade, because there's been a lot of trade in the last little over a week or two in MLCO. I've tended to focus on Las Vegas Sands and Caesars and that stuff, but this has been a high flyer and has gotten very, very overextended in the near term. In fact, if we bring up the expected move, the auto expected move, you'll notice that last week, and I can't remember if this is actually, I changed the code for it, and I may not have changed it back. We'll see whether this is 1 or 2 times the expected move. But yeah, this is 2 times the expected move. And this is pretty extraordinary, right? So this week right here, week of early November, early December, way, way above 2. This upper line is 2 times the expected move for the week. Traded way above it, touched it, and then broke through it last week. And we're sitting at that point. So basically 2 weeks significantly above the expected move. Basically what the options market was pricing for that week. And so all of a sudden we're seeing this large roll today to take some profits off the table. And we just closed last week 2 times the expected move. This is one that could readily come in to about $8 to $9 in here. So again, the roll certainly to about the $12 strike price says they're keeping some risk on the table, but it's more representative of a desire to take profits into significant strength like this. And that's where things like in-out spreads and that kind of thing can be very beneficial. Buying at 12, selling at 11, the vol skews going for you, etc. So anyway, we'll have to see. So again, people traders taking profits in today's rally. On the same front of Chinese stocks, you look at BABA. BABA has not been quite as exciting, but this is one over the last couple weeks. We've been actually going back to late October, early November. There's been a lot of bullish activity in Chinese companies. We've got this big rally. Again, the whole setup was Chinese reopening, lessening COVID restrictions, etc. And I've got this retracement drawn. So we've tested the 50% retracement of the prior downtrend. And now we're looking at the potential for reversal. Again, 1/3 hedge at 81, 2/3 at about 76.50. 2/3 at 71.76, 50% about 76.50. So we're looking at a potential of breaking down in Chinese stocks. And again, this is largely probably tied to the fact that if the dollar strengthens, if CPI comes in hotter than expected or maybe in line, we may see a little bit of selling going in the end of the year. And today in BABA, what you did see was an end of year, 30 December, okay, buying the 85, selling the 77 here. Looking at downside to 77. Well, 77 has you basically back to about the 50% retracement. That's not an extraordinary pullback. This is not atypical. Let me just remove these studies so I can see it. It's not atypical to see a correction back to this area. Again, but that probably indicates what? A stronger or maybe in line CPI report tomorrow, stronger dollar leading to some short-term weakness in the market. But on the flip side is, right? What if there's a bullish surprise, meaning the CPI comes in well below expectations? That's something that could lead to a really strong end of year rally, especially if Powell backs it up with his Santa suit and the relatively dovish a reaction to that data point. Maybe a bit of a long shot for that to happen, but we may start to see service prices start to come down. Wages probably still pretty hot overall, but again, we may see some of this service sector start to cool off as the goods sector has already cooled off a little bit. So there's that potential for a surprise that should lead for a pretty strong end of year rally, but don't hold your breath. Again, a lot of indications today the trade certainly looking at maybe a hotter or at least fearful of an inflation print that may come in line or hotter than expected. TLT today. Normally expect bonds on a rally to sell a little bit. Bonds were higher. And this is where things get interesting, right? A hotter than expected CPI print may pressure the Fed to raise rates, but that may end up hurting the longer term expectation in the market in terms of they may have to raise and even hurt the market more in the near term. That may help bonds. So watch TLT. I outlined a scenario back there in the 9th as an opportunity in Treasury bonds, TLT specifically, during one of my sessions, dovetailing with some unusual option activity. We've hit that 61% retracement. But then all of a sudden today, what you're seeing kind of crack open, if we take out 110, 120 starts to open up. And today, a trade late in the session and for a December expiration. So relatively short term, you're looking at what? The December 109, and then out here at the, let me sure I get the right one here. Should double check. So 109, 113. So 109, 113 here. So you'll see 24.27 selling the 113 there. Again, there's some other stuff in here as well, but the premise is long call vertical 109, 113, 16 December. Again, looking at some near-term upside or potentially just rolling a short call from the 109 to the 113 level, which either scenario is bullish, whether it's a spread or just a short call roll to the 113. Again, it's kind of interesting. Again, maybe we get some near-term upside here on a print. And, whether either direction, we may see just a curtailing in the inflation expectations going forward by virtue of the Fed reaction or just the wheels that are set in motion in terms of the market. And of course, higher rates, that does affect home builders like Lennar, for example. Lennar's at resistance right now. Do we break lower? They do have earnings coming up this week as well on the 15th. What is happening with sales? I mean, sales really dropped pretty substantially in the last quarter. We'll have to see what happens with Lennar. But today in trade was a February expiration, so it's not immediate, but it is out here a little bit. Out at the 77.50 put. Looks like mostly bought out here. And again, indicating some downside expectation. And if we look at the fib retracement off of this trend, that gets you to about a 2/3 retracement of the bullish trend off of the October low rather. And again, as you look at this again, out for February, again, just kind of providing that, just putting something in place. Now, buying a put is kind of expensive. Okay, 43% implied volatility. The skew is favorable. You may be more inclined to look at a vertical spread, buying a higher strike, selling a lower strike, just determining how far you want to go out of the money here. But, $1.40 or so, maybe you could buy a 82.50, sell a 77.50, a 5-point spread, and you get the opportunity of benefiting if we can drop back to prior lows by February. That'll maximize, gives you about a 3-to-1 reward to risk rather. Finally, we're going to wrap things up with two stocks. Last week we talked about being bearish in financials. Played out pretty well. Kind of held support in the last couple of days. Regional banks, commercial real estate, Morgan Stanley were kind of ones we focused on last week. Blackstone. This week it's UBS. We're consolidating up here. Again, a stronger dollar. Yields on treasuries falling. The yield curve inverting further. This is rather negative, in particular for money center banks like UBS, for example. Today's trade, as we look at the gap, we could close the gap here. But if you look at today's trade in UBS, a foul here in February, 1750, mostly bought. A spread could be constructed 1750, 15 for February, and cost you there about 45 cents. You look at there 45 cents on a $2.50 spread. That's $2.05 of upside if we can get back to 15 here, retesting prior lows by February. Even if it doesn't happen this week, again, some of Powell's statement may actually move interest rates, which may hurt banks, further inverting the yield curve. And heading into next year, as we start to recognize unemployment increasing, defaults increasing, very likely, we could readily see UBS and other financial stocks near lows. This has ran rather nicely. Seems like a reasonable time to start to take some downside shots heading into next year. Finally, we'll wrap up with EEM. And again, emerging markets, EEM is largely tied to Chinese stocks as well, but outsized representation there. But it's also the potential by next spring into summer. Does the Fed begin to reverse? Yes, EM may go to 34, but if the Fed reverses and the dollar begins to really sour and decline sharply, this does create an opportunity for EEM. And as you look out in time here, this is a ways out, no real gamma impact here, but I find it interesting. Out in the June expiration here, 125,000 contracts bought at the 47 strike. The implied volatility is pretty flat out here. Easy to construct it out of the money call spread if you want to reduce your risk, but that option only costs about 36 cents at the mid. It's not if you want to cast kind of a line in the water, a flyer that the Fed's kind of screws it up here in the next 6 months, and you start to see emerging markets start to soar. That's in essence what that is pricing in there. So at least some out there anticipating the Fed going dovish earlier than expected and causing the dollar to decline. So you can take it both ways. Short term, more hawkish. Longer term, more dovish. Both plays kind of played out today in the market. Anyway, that's all I got for today's session. We'll catch you back next week. Thank you.